Yeah, thanks everyone for joining this webinar series. Very, very pleased to be able to spend some time with Mike Ruscica from Note Conference. I've known Mike since 2000. Mike, was it 2000? End of 2008, probably. Right at the early days of of the financial crisis and non-performing loans. So it's great to have you. I'm looking forward to this chat.
Yeah, it's been a while. You were there from just about the start of when I discovered this crazy business.
Yeah, it's been a ride. It's been a ride.
I'd still be swinging a hammer, I think.
Yeah. I don't even know what I'd be doing, but cool. I'll give a quick background. So I've been in real estate since 2001. Actually graduated from Rochester Institute of Technology and thought I was going to be in the computer information technology business, but because of the dot-com crash, ended up making a pretty quick pivot into real estate. Started buying two-family houses, doing some brokering, some wholesaling, all the traditional real estate. And then after the financial crisis in 2008, I landed at a private equity fund that needed help from real estate people to handle the incoming short sales and the flood of foreclosures. So that's when we met in 2008 and pivoted into the non-performing loan space, and really grew with a number of family office and institutional groups in New York. At one point, we had over $3 billion under management. We'd have hundreds of foreclosures, 30,000 plus loans. After that, I did get an MBA. So some of the stuff we're talking about as far as inflation and macroeconomics, I had some of that beaten into my head over the last couple of years, more formally, in addition to just the experience that we've had over the last 20 years of real estate investing. Mike, why don't you tell everyone, for those who don't know you, tell everyone a little bit about yourself.
Yeah. So prior to getting into the real estate investment space, I was a machinist. I worked my entire life after high school in the back of a machine shop, and ended up building race car parts, which was really cool. Then I started investing in real estate, and I started expanding my network, and meeting guys like Jack Krupe, the people that are out there really doing stuff. I remember, I don't remember having a conversation with you on, I think you mentioned it was creative real estate investing online, CRE online. And I was out there hammering the boards looking for non-performing product. Right? Is that kind of?
Yeah, there's actually precursor to Bigger Pockets even. It turned out I was just starting to work with the fund that you were already familiar with. It's a small world.
So he was sitting in the back of the room, and I was one of the newbie students, and it's just crazy the way it worked out. Turns out that we both stayed in the space. We both ran with it. I met so many interesting people back in the early days. I realized that, hey, I don't have to just go out and get a job to make money. And so I created a couple of companies. I'm still building companies out today. We are working on a fund ourselves with a couple of people that Jack, and we're waiting for the next wave of stuff to appear. So I invest in non-performing junior mortgages primarily. I've been doing it since 2007. It's a great space, and I actually teach the business. I've formed a group called Fast Track Business. We meet every other Thursday night. In a very similar environment to the way I learned this business, so that I could introduce other people to other people. And it's been a fantastic run. We've done it over 2 years now, and we've gotten some very successful students to go out and do their own thing. So that's noconference.com. If you're interested, go to the front page and put your first name and email address in there, and we'll get in touch with you.
Awesome. So, again, this is going to be a pretty free-flowing conversation, but, I think the main topic we're going to try to highlight today is sort of, is how to succeed through economic cycles. We both mentioned the 2008 cycle. I mentioned the 2001 .com crash, which wasn't directly affecting real estate, but it caused a major pivot in my life. And over the last 2 years, we've had the COVID cycle, and what potentially is going to be a major inflationary cycle. So that, along with just talking about just efficient investing and how to really just generate strong returns. So I'm going to kind of run through. We have a couple slides that are just high level. Things like the definition of inflation. I'm not going to read these word for word, but the fact is, what I like to point out is there's potentially two different types. There's the consumer price index. There's what does milk cost? What does gasoline cost? And that's not necessarily proportional to asset inflation. With the Fed printing money, the cost of actual real estate, the cost of investment properties, the cap rates, the overall returns which investors will accept. Those are potentially two different things. So and we'll kind of go through that in some additional slides here. Pretty compelling chart right here. If you look at the 70s, and then Mike, I don't mean to date you here, but I think you've got a couple years on me here. So you remember probably a little more of what life was like in the 70s and 80s when there was rampant inflation. It wasn't the best time economically, right?
Yeah, I was just coming out of school, and my wife and I lived in Tulsa, Oklahoma, and we said, well, let's go back to New Jersey and buy a house. And so prices in Tulsa were like 60 grand, and we called up a mortgage place in New Jersey, and they're like, man, you can't get a garage for 60 grand. And so it was very interesting. I mean, you put your money in a bank, and it was actually making money in a savings account, which is ridiculously unheard of now. Gold went crazy. I remember I thought I was doing a smart thing, and I bought some gold, and that's actually how gold went up so high. I was able to start a business with that money and kind of start my entrepreneurship experience a little bit. But yeah, it was crazy back then.
Oh, that's amazing. I think it's, don't quote me on the exact numbers, but I think over the course of the 70s, from the time that the U.S. went off the gold standards, I think gold went from something like $30-something an ounce to 800. More than a almost 15x type 20x return. It's pretty.
My wife thought I was a genius. She's like, I think I picked a good one.
Nice. And you those are times we both as married man too. You remember those moments, the few times you get a compliment like that.
Yeah, it was an amazing time.
Yeah. So again, there's definitely a lot of fear that there's going to be significant inflation just with some of the money printing that's happened over the last few years because of COVID. So stocks are tend to be the most common investment that people have passively, whether it's through 401ks. Where they're sort of forced to be invested in the stock market, and there's a level of volatility well above what we typically see in real estate and note investing. Again, I'm not going to spend too much time on the chart, but I think anyone who's had money in the stock market or looks at their 401k has felt these moves personally. And one of the things I love about both real estate and mortgage, non-performing loan investing, reperforming loan investing is that, it's, generally a hedge against inflation in different ways. Real estate's different than the hedge against inflation on the mortgage side, even though there's certain inflationary issues that, potentially lower the value of mortgages slightly. But we'll talk about how, because we're buying at such a discount, it really doesn't affect it. So again, here's the hedges. You need to, real estate appreciates, rents are going to grow. And at least on the real estate side, having borrowed some money when you're able to borrow at these super low rates is a very good hedge. I'll mention that on the mortgage investing side, the hedge is that you're buying the debt at such a discount to the actual value, to the actual par value of the note. And additionally, if real estate appreciates, it actually can make the value of the debt that you own higher, just because it becomes less risky. So the more equity above the property, the more likely your loan is going to get paid off in full, which does increase the value. Again, here, these are just more statistics. I'm going to this is much more of a conversation, so don't need to spend too much time on the statistics. But Mike, just while we have these charts up here, what are your thoughts on how is the market of the last year or two and inflation sort of affected any decisions you've made as you've analyzed loans to buy?
Well, we have not done very much analyzing. Banks are just not really in a position to sell their notes at the moment. But what we did enjoy was, because of the last slide, you're talking about appreciation, and this slide, many of our borrowers have been able to sell their house, and what was once an underwater loan became full equity, and we've been getting full payoffs. And it's just been a fantastic run, and I want to thank my past self for buying all the garbage that I bought over the last 10 years, because these garbage loans that I actually forgot about are becoming full payoffs. So that's been a fantastic
that's awesome. That actually just reminded me. I wouldn't call this a garbage loan, but I certainly sold you a non-performing second mortgage at some point. I think
that was garbage.
It involved some cash showing up at the attorney's office.
A big guy with a big bag of cash showed up at the attorney's office, and the attorney called my wife. It was he said, there's a very large man with a bag full of money with $20,000 in cash. He owed us 50, and Mary had it on speaker, and she looks at me, and I'm like, take the money. What do you think you should do? Well, what if he doesn't give you the rest? I said, well, at least we got the 20, What are you going to go make him go home and bring it back when it's 50? And so, that was a fun one, Jack.
That's awesome. That's awesome.
But that loan, when I bought it from you, was completely no equity, underwater, Florida loan. And so I think I bought you a drink on that one already.
Yeah. It's a great story. Thanks for sharing. It's definitely I totally remembered the story, and I don't know that I'll forget that one. You hit the nail on the head that it's really, it's been hard to find. There's just been less inventory over the last year or two. Institutionally, there's a lot of loan sales from the government service entities like Fannie Mae and Freddie Mac, but those loans will take some time to trickle down, to the non-institutional market. And only a certain subset of those loans that Wall Street generally doesn't feel are the best fit for them to hold long term generally do trickle down. So one of the things I've been doing personally through our fund at JKAM Investments is, we've been investing a bit into multifamily real estate. I really wanted to have a conservative amount of leverage, but when interest rates are 3% or less in some cases, it's actually in many cases smart to borrow money and lock in long-term fixed rate debt. We're seeing, I mentioned before, the asset inflation versus the kind of the traditional, this inflation that'll get quoted in the consumer price index. And we're seeing asset inflation is significantly higher. There's just too many groups that are, that can't find yield when you have no return in a savings account, minimal return in bonds. There's only so many places to put money to earn a return, and a lot of that money is going into real estate. Rents are increasing nationwide, it's been a great place for us to have invested capital. And in addition to the actual inflation, we're really just doing traditional real estate value add, raising the value of the apartments by renovating apartments as they become vacant and improving the kitchens and the bathrooms and the flooring, and in some cases getting $200 to $300 more a month in rent.
That's great. Yeah. So you probably remember, Jack, back in the early 80s, there was a thing called inflation, and rents did go up, and it was, affecting me negatively because I was not a landlord. I was a tenant. Now, in the late 90s, I became a landlord through real estate, through multifamily properties, and they've squashed any type of inflation. And so for 20 years, I've been sitting around tapping my fingers on the desk going, when are the rents going to go up? Because they just keep squashing inflation. And now I think we're going to have runaway. So the properties that you're getting into now in 5 years, what do you think those are going to look like?
Yeah, it's, probably, many of them may double in value in 5 years, I think, with the one benefit of the fact that the cap rate and, for those that are not as familiar with commercial real estate terms, the cap rate is essentially the rate of return you would get if you paid cash for a property. It's the net operating income after, any property management, property taxes, divided by the purchase price. So it just basically takes out the debt service.
No cost of leverage.
Yeah, because every loan might be a little bit different. So it's a way to even the playing field and figure out what the rate of return is. Many buildings now, the cap rate is about 5%, or in some cases a little less. So that's the negative, is that the cap rate is only 5%. However, if you're raising the value of the property and you raise the rent in one unit by $200 a month or $2,400 a year, at a 5% cap rate, you're raising the value of that building by $40,000 to $50,000, $60,000 in some cases. And if you do that across 50 or 100 units of these buildings, and then you lower some operating expenses by being more efficient with utilities, putting in water saving, high efficiency toilets, putting in LED lighting. In many cases, you're raising the value of the building by 20 or 30% just by doing very minor improvements.
Nice. Not to talk about depreciation and all the tax benefits.
Oh, absolutely. Yeah, we should talk about depreciation, because as someone who is very heads down in the non-performing loan side of the business for a number of years, I had a bit of a blind spot for depreciation. And as I had made this pivot into also involving multifamily, it was really eye-opening. And it's actually a really good tool for note investors as well, to balance the income, especially if it's a passive income for note investing. If it's not, for those that have other businesses where, you're buying mortgages on the side, that's passive income. And you could balance that with depreciation off of, various real estate investments, and actually defer or offset the actual income that you would have made from the mortgage payments.
Nice.
So again, I don't want to belabor the stock market, but I think those of us that are into alternative assets are kind of already seeking these out, because we're aware of the various drawdowns of the stock market. I do have a little bit of money in the market, but I generally am real estate first, whether it's properties or notes. Then stock market is sort of a secondary, just because of the volatility. And unless you're a professional, it's very tough to beat the market. Whereas real estate and notes it's a more niche-y thing, where I think generally the more niche an asset class is, the generally the better returns that are going to be available.
The control is the big thing. In that last page you just showed, all the people that got caught in those situations had zero control. And that's control is everything. And you can control a property, like you said, by just changing the light bulbs.
Yeah, absolutely. And overall, and this is just kind of a generic chart on real estate, but overall real estate is massively outperformed the market since 2000. That's even including the 2008 crash. So vacancy rates are down across the board. I've been in various multifamily deals over the last number of years, and even through COVID, the vacancy rates were not significant, and the collections were also in the across the board mid 90% range for our portfolios. Now we're heavily in the Southeast, and then we have some allocations in Texas, Las Vegas, Phoenix. So the Southeast did extraordinarily well. Just wasn't hit as hard as sort of the Northeast with the eviction moratoriums. And generally a lot of essential workers, people paid their rent. Even Las Vegas, where it's obviously the tourism was hit a bit. It's really a minority of the economy. There's just a lot of other non-hospitality jobs in Las Vegas, and it's growing. And there's the influx of residents moving to Nevada from California. So it was really surprisingly resilient even through COVID. Oh,
that's great.
Yeah. So we won't spend too much time on this chart. Oh, go ahead, Mike.
No, I was going to say our rentals. We had 100% occupancy with payment. So they were just happy to have a place to live and through the storm.
Yeah. I mean, I think sometimes some of it's also headlines too. It's like there's always the outlier situations or the people who don't pay their rent or mortgage for years and have these nightmare scenarios. But I felt like across 30,000 loans plus that I've had some level of oversight of, a majority of people want to pay, want a place to live, want to do the right thing. And if there's a level of flexibility, like working out a modification, and that's really where I think we've created those efficiencies in the mortgage side of the business, is being able to see the big picture and not deny them because they forgot to send 2 pay stubs instead of 1, and make it easy to make a deal with someone and find a win-win situation.
Yeah. 30,000 loans, huh?
Yeah, it was a big number. It was a crazy ride. It turns into a different business at that point. When you're buying 500 or 1,000 at once, we had some very talented people that could do wonders with Excel spreadsheets and figuring out the projections of what percentage of loans were going to perform or not perform. But other than that, it was still the same business. Still, what is the property worth? What are the back taxes, if you will? And what will it look like if it modifies? What is our payment going to be?
Yeah, awesome.
Yeah, so I mean, you can obviously we've covered some of it, but let me know any thoughts you have that we maybe haven't covered on just the note investing side of the business.
Sure. Yeah. So truly passive cash flow. There's very, very few things in this world. I think I came up with about 25 different things where you can actually perform work once, and maybe it takes a month or 2 months, and then get paid for the next 20 years. That's truly passive income. And if you can focus on, and I don't think about 30,000 loans at once. I'm thinking about 1 loan at once. Especially when I started out, I work on 1 loan. I get that borrower, that non-performing borrower, to start making payments. And it's very rare that person will default again unless something catastrophic happens. And now I've got that borrower to start making $400 a month. And I did a 25-year workout. That's $400 a month for the next 25 years. That's just 1 loan. Now I've got time to go and work on the next one, and the next one, and the next one. And I've been doing this for 14 years. And that is a truly passive cash flow that gives me my entire day to do webinars with Jack Krupe and whatever the heck it is that I want to do. Maybe I'll meet you out in Vegas next time. So that's that's the reason that I'm so passionate about this non-performing note business. Even when things are rocking and rolling, I have a prospectus for New York Mellon Bank, I believe. And in their prospectus to buy their stock, they automatically build in a 4% default potential for the upcoming year, just because 4% of people default on their mortgage, whether times are good or times are bad. And I'm banking on my acquiring those 4% of mortgages, or some percentage of those 4%. And that's across the board. That's every bank builds in some type of number. So just because there's not a terrible downswing right now does not mean that there's not non-performing paper out there. We have tools that actually look, and we can see legacy paper from 2008 that the banks are still holding on to. Have you ever seen that, Jack? Where they just are not aware that they can get rid of this stuff?
Yeah, I mean, I know on the second lien space, there's some banks that just didn't, because of headline risk, or just it was too small for them to go through they just sit on it and just sort of wait to see what happens, or they're not sure if there's statute of limitations or not, or not sure it's collectible. There's an astounding amount of inefficiency in some cases of just big companies that just don't just
banking on
they don't know what they have. Cool. So why don't you take a second and tell everybody about what about No Conference, and sort of you alluded to it earlier.
Yeah. So No Conference. What I do with everyone, just like this call today, I told my students, get on this call. Everybody that I emailed, get on this call and see what these guys are doing. Not that this is a ploy for raising investment capital or anything like that, but be aware of what other people are doing when they start a fund. That's why I thought it was so compelling for me to do this series, not only because you guys are friends of mine, but for the educational purposes of my students seeing what it is. What are you guys looking at? You're looking at cap rate. You're looking at improvement. You are going to have to go out and raise some capital, because you're going to run out of your own capital pretty quickly. See what these guys are doing, what JKAM is doing, and take some tidbits and start thinking about creating your own fund. That's why I'm on this thing today. I thought it was a perfect opportunity to show my students what the heck you can do if you stop thinking small and go for it.
Great. Well, thank you for that. And I want to talk a little bit about multifamily, because this is what's turned into the largest allocation in the current fund. And I've been doing some investing just as a limited partner over the years, because when I was part of PRP Advisors and we owned 30,000 loans, I wasn't allowed to buy loans myself. I couldn't go and just grab 5 loans out of the portfolio and do it. It would be a conflict of interest. So, multifamily, to me, this is one of the best asset classes to be in overall. When you factor in inflation, when you factor in the low interest rates, and when you factor in the types of properties which we focus on, which are too big for a random one investor to do it themselves, but too small for the large publicly traded companies or private equity funds to do, because a lot of those groups are only doing $100 million type deals. So a 100 to 200 unit apartment building is right in that sweet spot where it's generally a syndicated deal. We used to call them country club deals, where a sponsor or sort of the key investor, the quarterback, if you will, finds a deal and needs to come in with a few joint venture partners to raise enough capital to execute the business plan. Class B is sort of that middle class house, middle class apartment building. We may call it workforce housing. People that are either somewhat just out of college and getting established, or just the working, Amazon delivery drivers, people who are, just in that spot where they're maybe saving to buy a house or just don't want the hassle. And, in this world, people are also moving around a lot more too. So you have low mobility because of COVID, where they can't, there's such a lack of housing supply. At the same time, there's also a lot of people moving. We're in Jacksonville. It had one of the highest population growths during COVID. People are flocking to Texas. So we're in markets that are just have a ton of growth trends in addition to the overall macroeconomic factors. So what we did was we created a fund, and although I've been managing investments for 20 years, I the last 10 plus, I've always had one big backer. Been managing money, but this is the first time we're actually taking money in ourselves. And so we went through the full cycle of doing a private placement memorandum. Mm-hmm. It's a SEC registered 506C. So it's open to accredited investors. And we use a third-party fund administrator called Strategic Fund Services. And we have a really cool investment portal where everything can be tracked. So
can you stay on that strategic fund for a second? Sure.
So yeah, they're our fund administrator. So they do all of the accounting and help with the compliance for the intake of investors, and they track all the investors' capital accounts and what their preferred return is, and exactly what we are paying quarterly. Then as the fund begins to return capital, they'll track the investor's basis. So for those that may not be familiar with the way a typical fund or syndication is set up, is you receive a preferred return on your investment, somewhat like an interest rate. Then you also receive a percentage of the profits. Now, that preferred return is only paid on capital that is still in use and not returned. So on a hypothetical investment of 100,000, we'll pay between a 6 and an 8% preferred return every year. Now, some of these buildings may sell in year 3. So we may actually return half of the investment capital in year 3. And so then you'd receive it on, say, 50,000 instead of 100, because we've returned half the money. Now, by year 5, we're likely to return all of the money. So investors would not receive a preferred return anymore, but they'll actually receive a percentage of the profits. And the way the current fund is structured, they'll continue to receive 70% of all profits for forever until the fund is closed down.
Just on the 50.
By year 5, the 50 is returned also. So yeah, once all the money's returned, then they only receive the profits, a percentage of the profits. And we only get paid once everyone has all their money returned, plus they've received their preferred return, plus have all their money returned. Only then do we start receiving our percentage of the profits.
Got it. Good. I appreciate you explaining that.
Sure. And then the other key thing is the tax advantages. We mentioned depreciation before. Even though we're actually paying a preferred return, so that example of 100,000, it would be, say, 6% preferred return annually. We'll actually show a loss on the tax return through a K1, because we're able to depreciate the value of the building. And these large buildings, you're able to accelerate it. It's something that's usually not worth doing on a single family house, but on a 100-unit building, you hire an engineering firm to do a cost segregation. And in many cases, you could take 75 to 100% of your initial investment and actually get a write-off the first year. So for a note investor, someone like yourself that's making significant money off of the borrower monthly payments coming in, you could actually offset that with a loss, as paper loss only, because it's not it's a profitable fund, but you actually show the loss until the buildings sell in year 5 or year 7. You basically have a loss, and you could also carry it forward. So that's a whole different webinar, and I think we've recorded other stuff, but the main point is, it's somewhat like almost like a retirement account in a way, where you're getting tax deferred income. You're getting income in your pocket day one, but you're not paying taxes on it because you're showing a loss on paper.
Beautiful.
Yeah, so this is the fund. It's primarily multifamily. We do have the ability to do other alternative asset classes, including self-storage. We did buy a small portfolio of a few non-performing loans, a few contract for deed, just kind of a mixed bag that's performing really well. But a bulk of what we're doing is the multifamily value add strategy, which is we talk about passive income. It's a big enough investment that it's safer and more passive. It's harder to manage a 2-family building than it is a 100 or 200 unit building, because at that 200 units, you're dealing with very professional, almost institutional quality vendors. Our deal in Jacksonville, the 9th largest property manager in the country is the manager of that property. So it's extremely efficient. Then the fund is, we have a private placement, it's set up as a $50,000 minimum, and there's a portal also, which makes things a lot easier. So tracking all the payments, once our fund administrator does that work, it's literally a few buttons I click to send out the quarterly payments. So it's a lot easier to create a fund now than it used to be, just because there's a lot of good technology
I love it,
to support it.
Nice.
Who knows what's going to happen in the over the coming years. I do expect that there's going to continue to be inflation, and I think this is a good hedge in addition to notes, non-performing loans. The key thing is it's that stuff like you mentioned, having more control and working on these more niche strategies that are off away from the standard institutional stocks and bonds. The more retail, the more public something is, the more boring and public it is, usually the worse the return you're going to get. Whereas these alternative strategies, just by nature have higher returns because they're below the Wall Street radar, and that's the key. If I can kind of leave just sort of a main point of just my overall investment philosophy is to be big enough that it's that you're dealing with professionals, and I did that on the note side of things as well as the on the real estate side of things, but small enough that you're not competing directly with Wall Street, and that's where I think significant returns are going to be found for anyone.
Yeah, but it's skill level too. I mean, it's not something that somebody can rush out next week and say, you know what, I'm going to go buy 100 unit. You just, it takes connections. It takes tenacity.
Yeah.
What else does it take?
Absolutely.
I mean, you tell me what else does it take?
And it's and there's a level of analytics too. To go through and understand the expense ratios and who the good property managers are. How do you make a connection with the 9th largest property manager that's willing to take you on? That goes to, it's a good point about sort of the passive side of things. I've been in a spot where I've created myself, a job that kind of trapped me to some extent. So, as you're trying to figure out investments, it's important to figure out if you want to be, the one, that's working full-time doing it, or do you really want it to be truly passive income? And if you're not careful, it's very easy to trap yourself into creating yourself a job again. So, what I love about the note side of things is there was a lot of professional vendors and support, just because you're dealing with the mortgage industry. We found that, we would have 600 REOs all over the country, and we had really good agents, a network of agents that were able to help take on the properties and help project manage repairs. So the support was very, very helpful. And where we fit on the multifamily side, as as a fund is that we're a programmatic investor with a few very, very high quality sponsors that are best in class. The guys that usually in their markets are getting that first phone call or the last phone call, or that are getting those off market deals. So we're setting ourselves up to not compete. We don't need to outcompete and overpay in a market, for example, because we're partnering with the guy who's getting the call from his neighbor that wants to be guaranteed that the property is going to close. So it's like choosing your battles, if you will. And we've been very successful with a number of joint ventures, both in the mortgage space and now. But it's really choosing your lane. And our lane is to be partners and collaborate and fit in where we do best, which is raising capital and allocating capital into quality deals, as opposed to fighting to try to outbid someone at an auction and overpay for a building. So nice. I urge everyone who's listening to figure out where your lane is. Are you really is your goal to control everything yourself and really be hands-on and basically create a job where you're just working for yourself, or is your goal to be on the beach somewhere and getting that mailbox money?
Great. Very good. Very good. That's good stuff. I appreciate you sharing all this good stuff with us.
Yeah. Do you have any closing thoughts on sort of the overall economy? Like what's your goal for the next few months here?
Next few months, we just started to a couple of the banks that we work with are just starting to open up the window again. I believe, from what I've heard from them, is some of them are still working from home. These are asset managers that have been selling us stuff for a while. They're just starting to go into the office one day a week, which is a big deal, I guess, for them. We had a couple of them actually retire during COVID because they're like, what the heck, let's just get out of here and start our retirement early. So I think the windows are just starting to open up. I expect that because we haven't seen product for 16 months, that means that's 16 months worth of these people not getting any type of commission off of this loan sales. So I hope that they're going to try to make up for that 16 months and move some serious product that I know they still are holding. And so it really is a patience game, which I have no problem with, because I'm a very patient person when it comes to these assets. Sitting on them, just we're doing a workout with a borrower right now to get paid off. She's literally been paying us for 8 years, and now she wants to do a refi and lower her interest rate, which is fantastic. So we're very patient with these assets and very patient with these banks, and we are actively pursuing more banks. We do have a new one that we're just starting to communicate with now through the hard work of my daughter and her husband, and very excited about that. So we're still working at acquiring assets.
I think there'll be a fair amount trickling down next year. Then working directly with the banks, I do think that I've read the book. Howard Marks has a great book about market cycles, and there's a quote he repeats a number of, and just those that don't know, Howard Marks was the founder of Oak Tree Capital. They were also very early. They'd raised a distressed fund in 2007, and they were one of the early buyers of the large pools of non-performing loans in 2008, 2009. And it's very well-known private equity fund. And he kept saying in his book, history may not repeat itself, but it does rhyme. So whereas I'm bullish on the overall real estate market, I think there's just not enough supply. There's not enough new homes built since 2008. So I'm not expecting a 2008 type crisis, especially with residential,
Right.
but I do think a lot of products are going to trickle down. And I also think the commercial side is where there's probably more pain. Using the same strategies of residential, of modifying loans, but doing that on the random 2-floor office building that's only 50% occupied, where the owner has some assets and resources, but is just sitting on an underperforming building that maybe is over leveraged. So using those same philosophies to buy the loan and restructure it, for the office buildings, for the retail, in addition to, there's going to be enough residential loans, like you said before, about the 4% that are just going to default because of life reasons.
Yes.
So yeah, I completely agree with you there. And from our side, we're just continuing to plug ahead. This is, in a way, it feels somewhat like a wealth management business for me, because I haven't, this is the first few years we're raising our own money as opposed to partnering with a big institution. I think my goal is just to get to know as many investors as possible and what their goals are, whether they're active investors that are looking to, partner on deals, refer deals, maybe looking for capital, to the truly passive investors who, or there are people who are doing both, that, are active, but maybe have a little extra money that was, sitting in a retirement account that they can't use themselves, that they'd rather have, or those that have a good amount of passive income and are looking for structuring depreciation, where our fund may be able to actually generate them a tax loss that writes off their current income, and is doing that math. So, the goal is for us just to have as many conversations as possible with people, so that we can understand how we can best partner and work together, whether it's as a passive investor, an active partner, or just, deal flow, or just helping grow each other's businesses.
Nice. Yeah, just from what you said, it gave me a couple of ideas. Maybe we should do a webinar on the benefits of a self-directed IRA or Roth IRA, and maybe that will actually free up some money that people just aren't taking advantage of the self-directed IRAs.
Yeah, it's definitely it's a key topic we're always happy to talk about. We've done one or two with other custodians that we have recorded, but happy to do another one as well. Even I think we both know some of the same people. Maybe we could actually recruit one of the attorneys to join us and just do a talk.
That'd be great.
Yeah, that would be awesome. I know there's some new regulations. I don't know what's going to actually be approved, but there's definitely some buzz about some changes in regulations as well. So we'll continue to monitor that.
Yeah.
Great. I think it looks like, looking at the time, I think we're right about where we should be wrapping up.
Did you want to see if there's any questions out there?
Yeah. If there's any, so I'm just looking at the Q&A. I see a couple. I saw a couple familiar faces on here. I see Jay is on. I see Angie is on. If there's any questions, feel free to type them in the chat, and we'll hang out for a minute or two here. And if not, then thank you all for joining. Looks like so we do have a question. Will there be a webinar on the self-directed IRAs coming up soon? Yes, we have a few recorded already, and then I believe there's another on the schedule with Alto IRA. I'm actually let me see if I could just grab the date right now. Otherwise, we'll certainly be sending it in a follow-up email. Yeah, it's going to be with Alto IRA. I will confirm the date, and obviously you're all on the mailing list already, so we'll have an email announcement out shortly with Alto IRA, and Mike's certainly welcome to join that one as well. And
awesome. I love the topic, man. I love the topic.
Yeah, and separately, I think you and I will work on the one with one of the attorneys we both know. I don't want to, not gonna put him on a spot and call him out live on the webinar for yeah. Oh, okay. It looks like the Alto IRA is the 26th. This month on the 26th, we'll have Alto IRA with a webinar.
Cool.
Great. So yeah, I think we're gonna wrap this for today, and then we have a third in our series coming up as well. And either William, or I will be on that. And Mike, I look forward to getting together with you, in person in New Jersey as well. I'll probably be up around the holidays, sometime Thanksgiving, Christmas time.
Okay. Yeah.
So
we'll meet you at the waiting room.
We're overdue to catch up in person, and look forward to breaking some bread again.
We have a high school reunion every year at the waiting room. The Saturday before Christmas.
Oh, wow. So, wow. Okay. Well, it's more than likely I'll be in New Jersey around then. So
quite a coincidence.
Yeah.
You happen to pick my hometown as your secondary location.
That's great. Well, Mike, it's always a pleasure. It's we've been through, known you since 2008 here. So 15 years of various business dealings, and always enjoy talking with you, and always learn something, and really looking forward to continuing to work together.
Yeah, you too. And cheers to your success. I've watched you grow. It's amazing to go from the back room of where you were to where you are now. That's great. And I guess I will see you in Texas.
Oh yeah, that's right. The Note Expo. Shout out to Eddie Speed and Bob Repass for the Note Expo. I think that's November 5th.
I'm in there on the 4th, and I'm out of there on the 8th. So I got plenty of time down there. My son's coming with me.
Awesome. Well, we'll get together then too. I'm sure we'll get a good group dinner going.
That sounds great.
Awesome. Well, Mike, thanks again, and everyone, thank you for joining.
Thank you. Have a great one, Jack.
Thanks. Take care.
Everybody, thanks for jumping on.